Joining us this morning, UBS Global Wealth Management CIO, Mark Haefele. Mark, it's great to have you back. So slowing growth, central banks in cutting mode, politics taking an outsized role. Talk about some of the numbers you'll be watching for.
Yeah, I think that you teed it up very well, and we're looking for the 10-year to fall to about 3.5 by the end of next year, and that is an environment where we think stocks can do well, and of course also bonds will do well. So it could be a great year for investors to get their portfolios in balance and get their asset allocation in balance.
So 3.5. Any expected year-end target on equities for a year-end 24, and where does U.S. fit relative to international stocks?
Yeah, well, we're looking for about 4,700 for the end of next year, which is not tremendous upside, but there is some. We have upgraded the U.S. from an underweight, and we're actually overweight in U.S. tech, because when we're screening things, we're looking for quality next year. Quality's our theme, and actually tech is showing a lot of quality, strong balance sheets, very high return on equity, and that's the kind of thing that our investors are going to be looking for. Who's going to be able to grow and maintain earnings as the economy slows?
Does that mean that any bounces in small caps are not to be trusted?
There's been it looked like there was a bit of a short covering rally in the Russell, right? I think they've been beat up tremendously, and maybe more on some of the small cap value. There's some real opportunities there still, but I think that one of the things about the AI revolution, which is really where we see the upside, is that it's these bigger firms that work across the value chain that may actually have a lead, and so the big could get bigger. I think for the smaller caps, what you're looking for is who's going to benefit as the interest rates fall, and it makes their financing go a little easier.
Mark, a lot of expectations of a soft landing in the U.S. for next year continuing. But what about the rest of the world? What about in Europe and in China, which is also critical for the U.S. earnings picture? They don't have the Magnificent Seven. They don't have as much fiscal stimulus. What happens to their economies and the impact on the U.S. stock market?
Yeah, I think it's a great question. So one of the interesting things about being a global investor and diversifying globally is that actually, China's economy is still relatively separate from the U.S. So the bleed over from, what is going on in China into the U.S. obviously isn't that great. So they're still separate. But we see China kind of stabilizing, maybe around the 5%, maybe a little bit higher in growth, and Europe kind of flatlining for next year. So that again leads to this picture of a global slower growth picture.
And it does raise questions about what it's going to mean for the U.S. dollar, which the market is very much embracing now, this weaker dollar on the back of lower Treasury yields. But I do wonder how much that can continue if everyone still thinks the U.S. is going to outgrow the world.
Yeah, I think that for the dollar, sometimes we have big calls on it. Right now, we're talking about playing the range and maybe selling upside on the dollar. The dollar has had just a tremendous run for a very long period. And as you get that weaker growth, there will be some question about, say, who cuts first. Is it Europe that cuts first or the U.S.? But we don't think there's a lot more upside in the dollar.